If you're sick and tired of blowing prop firm accounts, failing challenges, and just feeling completely lost, then this is the strategy that I want you to use. In this video, I'm going to share my step-by-step trading blueprint, the exact method that allowed me to pass multiple prop firm challenges and scale to six-figure funding, and actually works in 2025. But before we dive in, check out my latest funding account stats using this exact process. Now, it's not the fastest, but it's repeatable, and it actually keeps you in the game without paying for multiple prop firm challenges just to pass one and blow the rest. So the slow way is the fast way, and we can see the first position was on December, netting $400. December 2nd, small little profit. December 3rd, a break even pretty much. December 4th, another pretty small win, $500. And December 5th, again, we netted another $400 before the weekend here. And then yesterday, on Monday, we netted another $400-ish. I promise you guys, the slow way is the fast way. So let's get into it. So here's today's video objectives. Number 1, to understand exactly how this model works. Number 2, learn how to pass funding accounts consistently and without luck. And finally, to walk away with a clear, repeatable entry and exit checklist. Now here's our 3-step daily trading framework we're going to use throughout this entire video, and it is super simple. Number 1, we mark out our key levels. Number 2, we wait for those key levels to be swept. And number 3, we wait for our entry model. This is our trigger to go long or go short, to buy or to sell. That is it. Super simple. Okay, for step 1, we need to mark out our key levels, and these levels work together, so don't skip any of them. First, we're going to highlight the 9:30 a.m. candle, and we're going to mark out the candle high and the candle low. This is our first reference point for potential buying or selling opportunities. Next, we're going to mark out the closest bullish and bearish gaps that have liquidity inside them. Very simply put, that means the gap has been traded inside it already and price has left that area. The wick high for a bearish gap will be our key level, and the wick low of a bullish gap will be our key level. Price comes back down, we can see a reversal back higher. Don't worry, I'm going to show you guys some examples. It will all make sense later on. So here's how the 9:30 a.m. candle works. We can see in this example, at 9:30 a.m. we've marked the candle low and the candle high. If price trades beneath the low, we are looking for a bullish setup higher, and if price trades above the high, we're going to look for a bearish setup lower. But bear in mind, this is just step 1 in framing a narrative. And as we can see in the after example, price traded above 9:30 high and had a fantastic short opportunity all the way down to the 9:30 low before buyers re-stepped and regained control, pushing the market all the way back to the upside. Our final key levels that we need to mark on the chart is liquidity gaps. Now this is going to be done on the 5 and 15 minute time frame interval, and we need to mark the closest bullish and the closest bearish. It doesn't matter if one's the 5 and one's the 15, we just pick the closest one out of the 2 time frames. Now, liquidity gap sounds complex, but I promise you with practice and by the end of this video, you're going to understand it. A bearish liquidity gap is the wick high that's inside a bearish imbalance. Now, for those of you that don't know, a bearish imbalance is a 3 candlestick pattern where the wick high of candlestick number 3 and wick low of candle number 1 don't touch or overlap, meaning there's a sell side imbalance, buy side inefficiency in candlestick number 2. And very simply put, the market likes to use these as resistance to continue the market lower, which we see is what happened here. Now, we're not going to take the initial reaction. We're going to wait and mark out the wick high inside the imbalance. These are the best and the strongest, most potent pivot levels, where if the market comes back into this region, and sweeps the high, we're going to frame a short narrative back to the downside, continuating the bearish market. On the right hand side, the opposite is true. Liquidity gap in a bullish sense is we mark the wick low inside a bullish imbalance. A bullish imbalance is a 3 candlestick pattern where candle 1 wick high and candle 3 wick low don't touch or overlap. So we have a buy side imbalance, sell side inefficiency. Again, it's just a fancy support level that is high probable. What we're going to do is wait for the market to use it as support, leave, and then we're going to wait for those smart money traders to be stopped out before reversing higher. And we're going to frame a bullish narrative on the 1 minute time frame. And as we see in the bearish example, price is traded above the liquidity high here, but still respecting the gap, validating a true sweep of liquidity before resuming lower prices. On the right hand side, again, we've seen that price closed past the liquidity low, but still respecting the bullish imbalance, validating a true sweep of liquidity before resuming higher prices. Now, it's very important that you mark out these key levels on the 5 and the 15-minute time frame pre-market. You want to make sure these are all marked out so there's no confusion. As soon as the market opens, you know where your key levels are. But there's 2 important distinctions between a sweep of liquidity. Now, number 1, we have a candle closure past the liquidity low. That is still a valid sweep as long as price respects the bullish imbalance. Number 2, which is actually my preferred one, we can see we have the bullish imbalance here. Our liquidity low is here. And the difference is price has rejected the low versus closing past the low. This is my favorite one. It shows that bears are pretty much being resisted and bulls are supporting higher prices. Now that we've marked our key levels, this is how your chart should look. Both sides with levels clearly marked. On screen, you can see our 15-minute bullish and bearish liquidity levels and the 9:30 high and low. Now, in this example, the closest bullish level was a 15-minute interval, and the closest bearish was also a 15-minute interval. But do note, if the 5-minute was closer, I would have chose the 5-minute. And if the 5-minute on the bullish scenario was closer, I would have also chosen the 5-minute as well. Just this given day, the 15-minute was closer on both sides. Now, at this stage, no sweeps have occurred. So we're simply waiting for a liquidity sweep. And this is the beauty of it. We don't need to guess a bias. We just wait and react to the market. So if price comes up to 9:30 high and then sweeps the 15-minute high, that confirms a bearish narrative. And we can look for short opportunities. Now, if price sweeps the 9:30 low, and the 15-minute low, we can then frame a bullish narrative and look for buying opportunities. But if price just sweeps 9:30 without a 15-minute sweep, we ignore this setup as it's lower probable. Again, for the 9:30 low, if we sweep the 9:30 low without sweeping the 15, again, that's not a valid framed condition. You must wait for both sides to be swept. So as we see, price has swept the 9:30 AM candle low, framing a bullish narrative. We now need to wait for a 15-minute sweep of liquidity to really frame a bullish condition, which we see in the next slide. Price has now attacked the 15-minute, the 9:30 AM candle low. So we move on to step 3. Step 3, this is your entry model. Remember, we're bullish, so we need to see signs that bears are weak and bulls are strong. How can we find this? Well, we're going to mark out the first presented bearish fair value gap. And all we're going to wait for is price to close above the gap, confirming bears are weak and bulls are strong. So this is how you're going to approach it. You're going to place a limit on top of the IFVG with your stop loss at the structural swing low, and you're going to target a 1-to-1 risk to rewards ratio. I know this seems small, but remember, this strategy is for props and it's to build consistency. Once you build a buffer and you've been funded, only then can you extend beyond a one-to-one. But for now, we need to approach this as a prop trading strategy, meaning we approach it slightly different to your live funded capital. And I promise you, if you just follow this protocol, you're going to finally get a payout and stop blowing funding challenges and funding accounts. Only then will you become profitable. And the after, we can see that price retested the inversion fair value gap as support, and you made a one-to-one risk to reward, meaning if you risked $1,000, you made $1,000. That's it. Build consistency with time. I promise you guys, you're going to make it. So now let's move on to some live examples so you can see exactly how this plays out in real time. But before we do so, let's go over our trading rules. Rule number 1, you're going to stick to one trade a day for 90 days to build consistency and build discretion within your model. Number 2, there's going to be no entries the first 5 minutes of market open. This is based off New York Stock Exchange. Number 3, you're not going to trade bank holidays or any low volatile periods. You want the market to be high volatile as that gives us the best results. So let's go ahead and jump into the live charts. Okay, for example number 1, we're looking at the price chart of NASDAQ 100 on the 15-minute time frame. Now the date is the 5th of November and it's pre-market, which is just about to open. So let's mark our key levels. First things first, start with the 15 and then move down to the 5. Where's the closest bullish liquidity gap? We're zooming in here. We can see that price has had a low here and it's traded inside this imbalance, validating this as a pivot level. If the market trades back into this gap, we can frame a bullish narrative on the 1 minute. Now, what about the bearish case? I can see here to the left, price has a very small imbalance. You do need to make sure you take your time. It will get faster as you go, but we can see we've got a bearish imbalance here. Price is respecting the imbalance, meaning the wick high inside the bearish imbalance is our pivot level. If the market comes back, we can look for a short narrative back down. So let's label. And before we jump down to the 1 minute, we need to check the 5. Is this the closest bearish reversal? Yes. On the 5 minute, there's no liquidity bearish gaps. What about the 15-minute bullish case? We need to check the swing lows here. Are they inside imbalances? No. Until this one, it's inside this imbalance to the left, which is also our 15-minute anyway. So now we've got a 5 and 15-minute in conjunction. Okay. So going to the 1 minute. Now let's check our 930 high and low. And of course it's pre-market, so let's press play for a few candles. Okay, 930 high is here. You want to drag that across. Label 930. Do the same for the low. And now you want to go to your trading window, which is 934. Okay. So now 934, what has happened? Well, the first thing you should have said is price has swept the 930 low. So this is the first stage of being bullish. But until we sweep a higher time frame key level, we can't look for a bullish entry. So let's keep pressing play. Okay, now price has swept 930 and it's swept this 15-minute A+ gap. So what we want to do is mark out the closest bearish fair value gap that can be disrespected, which is going to be right here. This is the first presented bearish gap. If the price closes above it, we can frame a bullish entry on the retest, targeting somewhere around these highs for a 1-to-1 risk to reward. Let's go back, press play. Okay, we're using it as resistance. And now we've closed above. Okay, so now we've closed above, we can green light placing a limit directly on the IFVG, which is going to go here. You can press a limit buy. Why is it going to go here? Well, this is the bearish fair value gap. and now it's a bullish IFVG. So stop loss, we're going to place that when price fills us. Okay, we're pushing higher. Now starting to come down, and now we're in. So now we've been tagged into the market. Our stop loss is going to go underneath the swing low. We're risking $665, and we're going to target a 1-to-1. So if we risk 665, you want to make at least 665 back. Okay, press confirm, and all you need to do now is let the market play out. With time, and when you build a buffer, you can extend these targets to 930 high or the 15-minute gap as well. But remember, we're building a buffer, we're building consistency to stop blowing accounts. That's your first priority. So let's drag it to these to see. Okay, a bit of drawdown. Okay, now your target of a 1-to-1 has been completed. And you can see the final targets would be hit as well. Again, in time, you will master now. So let's go and check example number 2. For example number 2, we're looking at the price chart on the 15-minute time frame, NASDAQ 100, and it's pre-market open on the 4th of November 2025. So the first step, we need to mark out key liquidity points on the 15 and 5-minute interval. Now, for the first bullish liquidity point, I can see that there's a low inside this bullish fair value gap here. So looking to the left, we have this imbalance. We've got 1, 2, 3 candles, where the third candle wick low, first candle wick high have that support level for us. And more importantly, we have a wick low that's going to act as a pivot. So there's the closest bullish on the 15-minute time frame. What about the closest bearish? So now, because we were looking for the bearish, we want to check the swing highs. And the closest bearish is here, inside this bearish fair value gap. So that's going to be our bearish pivot. If price comes back to that level, we look for a short narrative. Now, dropping down to the 5-minute, we want to check, is this all done correctly? Or is there a higher level? So in terms of the bearish gaps, let's zoom in. Okay, so there was a bearish gap here, but price inverted it. And then the next one is here. Okay, so this is closer. So now, in terms of the 15 and 5, you would choose the 5-minute to frame your short narrative a lot earlier than if you hit the 15. Now, in terms of the bullish liquidity point, looking to the left, we have this support level. Price did close beneath the support level, but not the wick low. So I would frame that as a 15 and 5. Again, that's a little bit more complex how I read gaps and liquidity. If you want a separate video on that, do let me know and we can work on that. So now dropping down. Our key levels are validated. Let's go and check the 1-minute time frame. Of course, it's pre-market, so let's press play a few candles. Okay, 932. We can mark out the 930 high and the 930 low. So in this case, 930 has already been swept. So I'd be favoring being bearish. And 930 low still has not. Now, of course, we can't trade the first 5 minutes. So let's keep pressing play. Okay, now price on the 933 candle has swept 930 low and the 15 and 5-minute A+ liquidity point. So as soon as market opens, we can look for a bullish position. Okay, 935. Now to find our bullish position, we're going to mark out the closest bearish fair value gap, and we're going to wait for price to invert the gap. Remember, it needs to close above it, showing us that buyers are strong and bears are weak. So let's keep pressing play and see. Exactly like so. Replaying one candle here and deleting this. We're going to place a limit directly on top of the IFVG. Stop loss is going to go at the swing low. And we're going to target a 1-to-1 risk to reward ratio. Okay, we're in. Stop loss at the swing low. Risking $1,000. So we can also target $1,000 as well. Well, 980 both sides. That's a 1-to-1 risk to reward. Again, in future, you can target the 5-minute and the 15-minute as well. But let's build some consistency. So let's see how this played out. Okay, your 1-to-1 has been successfully completed, and price did run to the 5-minute before having a retracement, and then swept the 15 and just continued up for the rest of the day. So let's go and check one bearish example to hopefully make everything make sense. Finally, for example number 3, we're looking at the price chart of NASDAQ 100. The market is just about to open on the 3rd of November 2025. So we need to go ahead and mark out our key levels. Now we start on the 15 and work our way down to the 5. On the 15, where's the closest bullish liquidity point? Well, zooming in, I can see this structural swing low here is inside this imbalance. So this is pivot number 1, and this is the closest one for being bullish. Now in terms of being bearish, we need to look to the left. If we can see all the way across here, there's a bearish fair value gap, and price is traded inside it and respected it as resistance. So this is our bearish pivot point. But what about the 5? Does that confirm our narrative, or is there closer gaps? So zooming in. So the 50 minutes correct. And again, the 15 correct here. There's a small 5-minute gap and price is traded in it, swung low and then swung high. So that's a 15 and 5, making that level a lot stronger. Okay. So now let's go and check the 1 minute. On the 1 minute time frame, this is pre-market, so let's fast forward a few candles here and let the market open up at 9:30, like so. So here's our 9:30 candle high, and here is our 9:30 candle low. If price sweeps the high, we can look to sell. Sweeps the low, we can look to buy. Now there's something unique in this candle. Price on open has swept the 15-minute high as well. So all we need to now see is price sweep the 9:30 candle high and then see a inversion to the downside. So press and play. We have to wait a few minutes. So 9:34, we can trade 9:35. Now in this example, price has swept the 9:30 high after the 15-minute gap, but it's still valid. So what we want to do is mark the closest bullish IFVG in the leg, and this is your first presented bullish gap. If price closes beneath the gap, you're going to place a limit directly on the IFVG, stop loss above the swing high, and your target is a 1-to-1 risk to reward ratio. So let's do that. Press limit on the gap, slightly refined here, and we're going to go for a 1-to-1. Okay, so price filled us on the retest, stop loss at the structural high here, with a target at a 1-to-1 risk to reward. So we're going for $610, and let's see if price hits, which it does, relatively easy, but that is the whole way we frame this system. Remember guys, we're trying to get you prop firm payouts. The slow route is the fast route, and you're going to be able to scale with this system, build discretion, and extend your targets. Perhaps you want to target the 15-minute low here, perhaps you want to target London low. Now that you've made it to the end, if you want even more value, go ahead and join our free Discord. I post pre-market analysis every single day, economical updates, and you've got access to me. So join in the link in the description below. I'm trying to grow a community of like-minded traders. So speak to you inside the group. And remember to subscribe so you never miss a single video.